Chapter 15, Using Management and Accounting Information. Here are the learning objectives for this chapter. Although a successful business uses all four resources efficiently, it is information that helps managers reduce risk when making decisions. The more information, the less risk, and vice versa. Data and information differ in important ways. The average company maintains a great deal of data that can be transformed into information. There are systems used to sort out the pertinent information from otherwise useless data. Here are current business application software used to improve productivity. Management information systems are also called an IT system. Here's a visual showing how all business functions access management information systems. Each of these 5 management areas require different types of information to make decisions. So remember, too much information can lead to information overload. Here are the 5 management information system functions. They can collect data, store data, update data, process data into information, and then present information to users. Here's a typical visual display used in business presentations. And here's a typical 4-column table used in business presentations. Executives, managers, and employees rely on the firm's accounting system to provide needed financial information. Without the audit function in GAAPs or GAAPs, there would be little oversight of supervision. Unfortunately, the ones hurt when companies report inaccurate or misleading accounting information often are not the high-paid corporate executives. Rather, it's the employees who lose their jobs and the money they invest in the company's retirement plan if the company files for bankruptcy, and the investors, lenders, and suppliers who experience a loss due to their investments in the company based on fraudulent accounting information. To help ensure that a corporate's financial information is accurate and to prevent the type of accounting scandals that have occurred, Congress enacted the Sarbanes-Oxley Act. There are special areas of accounting expertise: managerial accounting and financial accounting. There's also cost, tax, government, and not-for-profit accounting. So accountants must be responsible, honest, and ethical, strong background in financial management, know how to use a computer and software to process data, and then be able to communicate. So here's the accounting equation, and that's the basis for a firm's balance sheet. Assets equals liabilities and owner's equity. The total assets must always equal the total liabilities plus the owner's equity. A statement that reports a company's financial condition is a balance sheet. Here's an example of a personal balance sheet, and this is what a business balance sheet should look like. So balance sheets list assets, and this is what current assets will look like on the balance sheet, and then fixed assets, and then lastly, intangible assets, or assets you can't touch. Balance sheets also list liabilities. They list first current liabilities, And then long-term liabilities. And then balance sheet also lists the owner's equity. And if you don't have that number for whatever reason, you know that you can subtract all the liabilities from the assets, and then what's left over is always going to be the owner's or stockholders' equity. The income statement identifies if there is a cash surplus or deficit. Here's what a personal income statement should look like, and here's a business income statement. So revenues is a total, or the income statement lists the revenues and net sales. And then also the cost of goods sold, and then the gross profit. Then the operating expenses, and then the net, and then you used all these numbers to find either the net income or the net loss. I'm not going to have you memorize any of these formulas here. We just use the income statement to find if they have money, or if they have an income, or if they have a loss. The statement of cash flows identifies how well a company can manage operating, financing, and investing activities. Here's an example of a statement of cash flows. So it shows the results of past business decisions and reflects the firm's ability to pay debts and finance new growth. And here's a comparison of present and past financial statements for Microsoft Corporation. And then the last 3 slides we are going to skip. That's it for today.